Let me start with a thought that might sit awkwardly with some people, but it needs to be said out loud. If the monetary system is fracturing the way it increasingly appears to be, then asking, when do I sell my gold and silver, may already be the wrong question. It is a bit like standing on the deck of a ship that is clearly taking on water and calmly negotiating the resale value of your lifeboat. Technically rational, sure. Practically insane, maybe. And before anyone gets defensive, this isn't about panic or drama. It's about framing. Now, quick honesty moment. I see the data. A huge number of people watching this kind of content never subscribe. So if any of this resonates, if it sharpens how you think about money and risk, do me a favor. Hit subscribe, drop John AG in the comments, and let me know you're actually in the room with me. All right, let's get into it. Overnight, we watched gold push back toward the high 4,800s and silver flirt with the mid to high 90s. And I know exactly what that does to your brain because it does it to everyone in MS brain. That little internal voice pipes up and says, this is it. This is the top. Take profits. Don't be greedy. Don't round trip the move. And to be fair, that voice isn't stupid. It's well trained. It's been conditioned by decades of fiat logic, by charts priced in currencies that quietly lose purchasing power every year by endless advice to sell the rip from people who assume the system they grew up with is permanent. But here's the uncomfortable question I want you to sit with. What if the thing you are measuring your metals against is the thing that's actually failing? What if the goal isn't to cash out into paper, but to carry real money forward and then exchange it for assets when the ratios become absurdly favorable? That shift alone changes everything. Today, I want to unpack this properly. We'll look at what a very well-known macro investor recently admitted in public, the kind of statement that usually gets whispered behind closed doors. We'll connect that to what bond markets are quietly screaming right now. And then I'll deal with the real question most people never articulate clearly. If you didn't sell metals into fiat, then what exactly is the exit, and how do you recognize it when it shows up? I'll give you a practical framework you can actually use. Not vibes, not fear, not gut feelings at 3 a.m. One quick note before we go deeper. Check the description if you want to go further. There are bonus links there, including access to our premium WhatsApp channel and channel membership for those who want more depth and want to support the work. Now, let's talk reality. The mainstream financial world is very good at hiding bad news behind polished language. They don't say the system is wobbling. They say liquidity event. They don't say the debt can't be paid back. They say fiscal adjustment. They don't say people are losing faith in paper promises. They say risk off rotation. Same problem, nicer suit. But every so often, someone high up slips and says the quiet part out loud. This week, the billionaire hedge fund figure, one of the most recognizable names in global finance, sat on a major stage and essentially said, the monetary order is breaking down. Not temporarily, not cyclically, structurally. When someone like that says it, you don't clap, you lean forward. This isn't about idolizing personalities. I don't care who said it. I care what it implies. And what it implies is that central banks are changing behavior. Capital is moving differently, and assumptions that were once considered sacred are now being questioned by the same institutions that used to sell them to you as gospel. Here's the key distinction most people never internalize. Fiat currency is created as a liability. It is born from debt. Every unit has a matching IOU somewhere in the system. Gold doesn't work like that. Silver doesn't either. There's no counterparty risk, no promise that can default, no balance sheet that can blow up and take your purchasing power with it. That's why, when systems get stressed, capital doesn't run to more promises. It runs to things that exist. And this isn't just retail behavior. Central banks are doing it. Institutions with better data and better access are doing it. The people who understand the plumbing best are quietly moving away from pure paper exposure. So ask yourself honestly, why would you sell your lifeboat while the ship is still listing? Now, I can already hear the objection. Okay, but everything has a price. Surely there's a level where you sell. And here's where the answer surprises people who are still anchored to dollars, pounds, or euros. I'm not planning to sell gold and silver for more paper. I am planning to exchange gold and silver for real assets when the ratios become ridiculous in my favor. That's not wordplay, that's strategy. Selling into fiat assumes fiat is the destination. In a monetary transition, fiat is not the destination. At best, it's a bridge. At worst, it's a trap. Think about wealth differently for a moment. Not as a number on a screen, but as how much real-world control you have without asking permission. Land, a business, productive equipment, inventory, rental property, a farm, energy infrastructure, even a simple, stable home with no debt. Moving from metals into those assets isn't about calling tops. It's about watching relationships. Here's the analogy that tends to stick. We're on a monetary Titanic. Most people are still in the ballroom because the music hasn't stopped. They're in the casino because the lights are still on. They're watching stock tickers because the scoreboard still updates. But But you can feel the vibration under your feet. You can see water creeping in. You can see the crew getting nervous. Gold and silver are the lifeboats. Gold is the compact one. Fewer seats, easier to carry serious value. Silver is heavier, more crowded, but accessible and historically important as everyday money when things get strange. And if you knew the ship was going down, you wouldn't throw the lifeboat overboard because someone offered you casino chips for it. So when do you exchange? You exchange when the lifeboat buys you something better than safety, when it buys you stability, productivity, and long-term control. That brings me to the framework I use. First, the system signal. If bond markets are unstable, currencies are being diluted, and central banks are hoarding gold, that signal is flashing red. That's not when you reduce insurance. That's when you're careful about what you call profits. People consistently make the same mistake in monetary transitions. They sell real money too early and buy paper claims right before paper claims get repriced. Second, the ratio signal. Stop asking whether gold is expensive. Ask what it buys. How many ounces of gold buy a house where you live? How many ounces of silver buy a reliable vehicle? How many ounces of gold buy a diversified income-producing asset? When those ratios hit historical extremes and real assets become cheap in metal terms, that's when you exchange. Most people will do the opposite because the fiat price feels normal. You don't have to. Third, the personal signal. This one isn't glamorous, but it matters. Your life matters. If you need liquidity for a real emergency, if you have an opportunity that genuinely improves your cash flow or resilience, you may exchange a portion. The goal isn't to die holding perfect coins. The goal is to live better, safer, and more free. Now look at what's happening in markets. Bond markets are supposed to be boring. When they start behaving like meme stocks, that's a warning. We've seen long-term government bonds in major economies get crushed, bounce a little, and get celebrated as stabilization. Traders call that a bounce in a falling market. The math doesn't lie. Massive debt plus higher rates equals political impossibility. So policymakers do what they always do. Cap rates, print money, or change the rules. Sometimes all three. Over time, every one of those paths benefits hard assets, even if the ride is volatile. Add inflation to that. Real inflation, not the politely adjusted version. And for those wondering about trading, futures, options, and calling tops, understand this. There's a place for speculation, but in a monetary reset, speculation is where people get shaken out. Paper markets will move violently, headlines will scare you, commentators will laugh. It's not a bug, it's the design. Let's reset the frame for a moment, because this is where a lot of people get nudged into making the wrong decision. There's a reason the system constantly encourages you to sell your lifeboat the moment a chart turns red for a couple of weeks. Volatility is the pressure point, fear is the lever, and impatience is the outcome they're aiming for. If you're serious about protection, not speculation dressed up as protection, you need to mentally separate your metals into two very different buckets. The first bucket is your core protection. This is not trading inventory. This is not something you touch because a commentator got excited or a candle went the wrong way. This is what you only exchange if it materially upgrades your life or secures something genuinely generational. Land, a debt-free home, a productive business, real infrastructure. The second bucket is tactical. This is where, if you know what you're doing, you can rebalance, trim, add, or trade around moves. But here's the rule people break over and over again. You never, ever risk your core protection for a tactical win. That's how people end up right once and broke later. And this is where that recent comment from a major macro investor really matters. When someone operating at that level openly admits that central banks are no longer treating fiat and government debt the way they used to, you should ask the obvious follow-up question. If they're not holding that, what are they holding instead? The answer, backed by years of data rather than opinions, is gold. Not because it's fashionable, not because it trends well on social media, because it nests the one monetary asset with no counterparty risk that has functioned as settlement across empires, wars, resets, and collapses. You don't have to copy central banks, but ignoring the direction of their flow is rarely wise. Now let's talk about the real danger zone, which isn't price volatility, it's psychology. Gold goes up and people feel clever. Gold goes down and they feel foolish. That emotional whiplash is pure fiat thinking. In a real money mindset, you don't measure your position by a flickering paper quote. You measure it in ounces, because the paper price is just the stressed opinion of a system under pressure. The ounces are the reality you actually own. That's why when people ask me, John, when are you selling? My answer doesn't change. I'm not selling my insurance policy because the premium went up. I am holding it until the world offers me an exchange so compelling it would be irrational to ignore. Let's make that less abstract. Picture a future, not some sci-fi fantasy, just a plausible one, where a solid piece of land can be purchased for a single ounce of gold. Picture productive farmland priced in ounces rather than constantly adjusted currency units. Picture a moment where building materials and labor have been repriced, credit is scarce, and the people holding real money can build, buy, and invest, while everyone else is filling out loan applications and hoping for approval. In that environment, the decision isn't about hitting a price target. It's about recognizing that stored purchasing power can now be converted into long-term production. That's the handoff. And it almost never happens in one clean moment. It happens in stages, which is why you exchange in tranches as ratios become attractive instead of emptying the vault all at once. Quick side note, because people ask this often. If you're interested in real-world silver stories, not theory, but actual outcomes from regular people, there's a link in the description to another channel that focuses on that. Worth a look if you like practical examples over abstract debates. Now back to the signals that actually matter. One of the most overlooked indicators is the Dow to gold ratio. Take the stock index and divide it by the price of gold. When that ratio falls, it tells you gold is gaining ground relative to equities. Historically, major regime shifts show up there long before headlines catch on. We've been flirting with psychologically important levels, and if that ratio continues to compress, it suggests capital is slowly rotating out of financial assets and into hard money. That matters because it hints at what the next big trade could eventually be. If gold becomes dramatically strong relative to stocks, exchanging gold for productive businesses or real enterprises someday could be the trade of a lifetime. But not yet. Not while the ship is still taking on water and policymakers are insisting everything is perfectly under control. Now, there's a trap on the other side of this conversation, and it needs addressing. Some people hear all this and conclude they should never exchange at all. That's not the message. Gold isn't the finish line, it's the bridge. And the destination on the other side of that bridge is control. Control over your time, your living situation, your family's stability, and your dependence on fragile systems. The mistake isn't exchanging. The mistake is exchanging into weaker money instead of stronger assets. Silver deserves its own moment here because silver is where emotions run hottest. Silver moves faster. Silver is more volatile. Silver has humbled more traders than almost any other market. And that volatility is precisely why silver can become so powerful during a transition. When silver moves, it doesn't tiptoe. It shocks. It grabs attention. And suddenly, the affordable lifeboat isn't affordable or available anymore. So ask yourself this honestly. When silver gets mainstream attention again, do you think the average person will calmly buy it at will? Or do you think they'll arrive late, face delays, premiums, empty shelves, and then blame everyone except their own timing? That's why positions are built before euphoria, not during it. I want to pause here and actually engage you because this matters. When you think about your metals right now, do you think in price targets or in purchasing power? Which mindset are you operating in today? And second, if the monetary order really is shifting, what is the first real asset you'd want to exchange metals for when the time comes? Land, a business, a home, equipment, something else? Put it in the comments. And if you've had any financial win recently, big or small, share it. Paying off a debt, building an emergency fund, making one smart decision, you'd be surprised how much that helps someone else stay steady. Let's zoom back out to the big picture because the core theme here isn't that gold is going up. It's that the credibility of paper is going down. When credibility erodes, people demand higher compensation or they leave. That's what capital conflict looks like in the modern world. Not tanks and borders, but flows and exits. And when those flows change, markets behave in ways that confuse people who are still playing by old rules. If you're trying to time a top in gold while trust itself is being renegotiated, you're playing the wrong game. The better game is to hold the asset that doesn't tee up, require trust, and wait patiently for the world to offer you real things in exchange. To keep this grounded, here's a simple practical approach. Maintain a core position of physical metal you can actually access. Don't leverage it. Don't borrow against it to chase yield. Track key ratios monthly, not obsessively. Housing to gold, stocks to gold, land to gold, energy to gold, whatever matters in your real life. Build a clear plan for what you want to acquire and at what ratios you begin exchanging. And don't wait for the news to tell you it's safe. The news is always late and usually wrong at turning points. Another reminder before we wrap. The description includes links to the premium WhatsApp channel and channel membership. For those who want deeper analysis, there are members-only videos produced with a separate research team where we go far beyond what can be said publicly. If that's useful to you, consider joining. So where does all this leave us? It leaves us in a world where gold and silver are not trades first, they're protection first, they're a quiet vote against currency debasement, They're a way to step outside a system built on promises and hope. And when you treat them that way, you're just far less likely to do exactly what the system wants you to do. Panic sell your protection during a manufactured scare. I'll leave you with one final thought, because this is the part most people still miss. Monetary systems don't break cleanly. They fracture in phases. First, confidence erodes quietly. Then, markets start flashing strange signals. Bond volatility, currency weakness, sudden policy shifts. Then authorities respond with solutions that create new distortions. And finally, almost overnight, the public realizes the rules changed. The question isn't whether that moment comes. It's whether you were positioned before it became obvious. So no, I'm not selling my gold and silver into paper. I'm holding. I'm watching ratios. And I'm preparing to exchange into real assets when the opportunities are historic. If you want more content on specific ratios, timing frameworks, or how to think about exchanges based on different life situations, tell me in the comments so I can tailor future videos to what you actually need. And if this helped, subscribe. It genuinely matters. Drop John AG below so I know you're part of the core community. Take care of yourselves, take care of each other, and I'll see you in the next one. At a certain point, something subtle but powerful happens in the way you think about money. Prices stop being abstract numbers and start translating into real life. They turn into how many bags of groceries, how much fuel, how many months of rent. The unit shifts, and once that switch flips, your brain doesn't really go back. That's why I keep saying stop asking whether gold is expensive and start asking what gold actually buys. Because this is no longer a normal market cycle. It's a credibility cycle. And credibility problems don't show up first in flashy places. They show up where trust matters most. That's the bond market. Bonds are supposed to be dull. They're meant to be the beige carpet of finance. Safe, predictable, something adults nod approvingly at. So when long-term government bonds start moving violently, that's not background noise. That's a flare in the sky. We recently watched long-dated bonds in a major economy sell off hard and then bounce. Some people rush to call that bounce relief. But a bounce after a sharp fall doesn't mean the danger passed. Often, it just means the market paused to breathe before the next move. The reason this matters is simple and uncomfortable. When debt loads are massive, the math becomes unforgiving. Higher yields mean higher interest costs. Higher interest costs force ugly choices. Cut spending too aggressively and growth breaks. Raise taxes too much and social cohesion breaks. Print too much money and the currency breaks. So the system drifts toward what feels easiest in the short term. Financial repression. Keep rates below true inflation, quietly transfer wealth from savers to debtors, and call it stability. That's how a so-called safe asset turns into a slow-motion loss. You might get paid back on time, but what you receive buys less than what you gave up. And if the measuring stick itself is melting, trading your lifeboat for that measuring stick isn't a win. It's a step back into a promise. Inflation is the invisible pressure behind all of this. We just saw UK price data tick higher again. Whether you believe the official numbers or you believe your grocery receipt, the direction is what counts. If prices rise faster than deposit rates, cash loses ground. That's a tax nobody votes on and everyone pays. And when this happens across multiple countries at the same time, you don't get isolated problems. You get a global repricing of hard assets. Not because those assets changed, but because the currencies did. This is also why central bank behavior deserves more attention than daily price swings. Don't fixate only on tonnage. Focus on intent. When central banks reduce reliance on a single reserve currency and increase neutral reserves, that's not a trade. That's a strategic shift. Some countries are now openly announcing increases in gold reserves and long-term targets. That's not random, that's planning. And history is clear on one thing. Institutions position first, the public follows later. When the public finally moves, the story stops being about price and starts being about availability. Paper claims can be created instantly, physical metal cannot. A quote on a screen is an opinion, a coin in your hand is a fact. So let me give you a simple checklist that helps prevent the classic mistake at exactly the wrong time. First, don't dump everything at once. If you ever exchange, do it in tranches. Second, don't confuse profit with progress. Progress is acquiring something that genuinely improves your life or secures your future. Third, don't ignore friction. Spreads, taxes, delays, and timing all matter. Planning ahead keeps you out of forced decisions later. Here's a rule that helps remove regret from the equation. Exchange a portion only when three things line up. 1, the ratio makes sense in your real world. 2, the asset you want is high quality and actually available. 3, your personal situation is stable enough that the exchange increases control instead of adding stress. If all three are present, you can act calmly. If not, you wait. And waiting is not weakness in a monetary transition. Patience is a weapon. Volatility and headlines are designed to exhaust it. Now, a quick community moment, because this matters more than people realize. If you've had any success recently, Paying down debt, starting a side income, building savings, making a disciplined move, share it. It keeps the conversation grounded in real outcomes instead of fantasy timelines. And keep an eye on that stock to gold ratio. When ratios reach historic extremes, that's when generational exchanges tend to appear. Hard money into productive assets while the crowd is still confused. This is why I'm not looking for a magic dollar price to sell. I'm watching system signals, ratio signals, and my own personal signal. When those align, I'll convert stored purchasing power into real ownership. Until then, I'd rather hold something real than chase something promised. Timing is where people usually get themselves into trouble, so let's talk about it plainly. In markets, the biggest money is usually made by being positioned before the crowd understands the story. The biggest mistakes are made when the crowd finally understands, and you assume that means the move is over. If your plan is to wait for a front-page headline announcing a new monetary era, you'll be late. By the time the average person believes currency dilution is real, it already happened. By the time bonds are widely viewed as risky, yields already moved. By the time metals are universally respected, easy physical supply is already gone. That's why the exit isn't a single dramatic moment. It's a series of decisions. And those decisions are easier when you recognize the phases. First comes denial. This is temporary. Then distraction. People chase entertainment markets and ignore boring signals. Then policy shock. Something breaks, authorities respond, volatility spikes, then normalization. The public quietly adjusts to a lower standard and calls it normal. Finally, acceleration. Confidence erodes faster, and even experts are surprised by the speed. You don't need to label the phase perfectly. You just need to know phases exist and they done T reverse because someone on television says all clear. Silver fits into this framework in a very particular way. Silver is emotional. It's volatile. It has a habit of feeling like it's mocking you personally. It rallies when you're cautious and dips when you finally feel confident. That's normal. Silver is small relative to global markets, so it can be pushed around in the short term. But that same smallness is what allows explosive upside when monetary demand and real-world demand collide. If you hold silver, think of it as the more turbulent lifeboat. It rocks, it splashes, but it still floats. This is where the two-bucket approach becomes essential. One bucket is core. That S, the portion you done, T, touch unless you and I are exchanging for something genuinely life-changing or generational. The other bucket is tactical. That's where you can rebalance, trim, or redirect without risking your foundation. This structure protects you from the all-or-nothing decisions that wreck people psychologically. Another angle that doesn't get enough attention is capital conflict. Modern conflict isn't just about borders and maps. It's about who holds whose debt, who depends on whose currency, and who can exit without collapsing their own position. When a country runs deficits, someone else holds that paper. If that holder loses confidence, the flow changes. And when flows change, things that once felt normal suddenly look fragile. That's why reserve diversification matters. That's why neutral settlement assets matter. And that S, why assuming yesterday, safe asset will always be tomorrow. And safe asset is dangerous. Bring this back to your own situation. If you're holding metals and feeling pressure to do something, remember this. Doing nothing is also a decision. Holding is a position. Waiting for ratios is a strategy. The system tries to shame patience. It calls it missing out or being wrong. In reality, patience is what keeps you from being forced into bad trades. When the opportunity finally appears, when a real asset becomes cheap in gold terms, you want the ability to act without begging for financing in a high-rate environment. That's when metals stop being just wealth and become leverage in the real economy. Not leverage as debt, but leverage as optionality. Choice, flexibility, the ability to move when others can't. That "That's why I done" to want you thinking like a day trader when the topic is long-term protection. Think like a builder. Think like an owner. Think like someone preparing to exchange stored purchasing power into something that pays dividends for decades. If you want to follow up where we map out example ratios, housing to gold, land to gold, indexes to gold, adjusted for different regions and budgets, say so. I'll build it around what's actually useful. And don't underestimate how fast public mood can flip. Metals are ignored for years. Then one weekend a bank headline hits, a currency drops, or a new temporary control is announced, and suddenly everyone wants the same ounces at the same time. That's when the difference between paper and physical becomes obvious. Paper trades instantly. Physical runs into limits, delays, and premiums. Not because anyone is evil, but because supply is finite. If you're holding physical, you're holding time. You're holding priority. And if you're still building, do it steadily, not emotionally. Consistency beats panic every time. Keep your head, keep your plan, watch the signals. The next phase won't be gentle for the unprepared. Write your plan down, make sure your family understands the basics, keep some liquidity for life, and remember, the goal is security, not stress.